Peter Lynch is known as one of the world's greatest investors, having achieved a 29.2% annual average return while managing the Fidelity Magellan Fund over a 13-year period. And during his tenure, Fidelity Magellan became the best performing mutual fund in the world, consistently crushing the S&P 500 returns by over double. Now, over the past few months, I've been reading Peter Lynch's One Up on Wall Street, which is arguably one of the best books ever written on investing. In his book, Peter Lynch describes the perfect stock, where he details the 13 most favorable attributes to watch for, helping any investor find what he likes to call a multi-bagger stock. Surprisingly, these characteristics aren't what you might think, and some are actually pretty funny, but Lynch has some very good reasoning behind all of them, so stay tuned for the entire video. Anyways, if you do enjoy, make sure to smash the like button to help support my channel, as it does really help out. I really do appreciate that, guys. And if you haven't already, definitely consider subscribing down below for more investing content coming very soon. But with that said, let's get into Peter Lynch's 13 ingredients for the perfect stock. Starting off with attribute number 1, it sounds dull, or even better, ridiculous. In his book, Peter Lynch mentions how he loves investing in simple businesses that he can understand, just like Dunkin' Donuts. Whenever someone would say any idiot could run this business, it's a bonus to Peter Lynch. Therefore, he says the perfect stock has to be connected to a simple business, and that simple business ought to have a perfectly boring name. Two examples of companies that he gives are Automatic Data Processing, or ADP, and then Bob Evans Farms. Like, what could be duller than a stock named Bob Evans? Furthermore, one of the most promising names he's ever heard in a company was Pep Boys, Manny, Mo, and Jack. That's because the name is absolutely ridiculous. Like, who would want to put their money into a stock that sounds like the Three Stooges? Peter Lynch says if you discover an opportunity early enough, you'll probably get a few dollars off the stock price just for the dull or odd name. In other words, the less attention that the stock gathers via its name, the more of an opportunity you're going to have to buy those shares at a discount before it takes off. Now, moving on to attribute number 2, it does something dull. Again here, Peter Lynch isn't looking for a company that's building futuristic electric vehicles or e-commerce websites. He's looking for a simple business. One example he shares is the stock named Crown Cork and Seal, which makes cans and bottle caps. Like, what could be a more boring business than making bottle caps? Another example is Agency Rent-A-Car, which actually rose from $4 to $16 per share during his tenure. Boring businesses will typically have less competition than those in exciting industries, thus giving them sustainable competitive advantages. A company that has both a boring name and a boring business model is terrific in Peter Lynch's eyes, since you'll have much more time to purchase those shares at a discount before the trend followers jump in and the stock price explodes. Thirdly, it does something disagreeable. Peter Lynch argues that better than being boring alone is a stock that's both boring and disgusting at the same time. He says ideally the company should be doing something that makes people shrug, retch, or even turn away in disgust. And he gives the example of a company called Safety Clean with a K. This company would provide gas stations and body shops with a machine that cleans greasy auto parts, and then they would also remove the grease and the sludge from those machines periodically. The company then expanded into restaurant grease traps and other sorts of messes, which allowed them to increase their earnings every quarter for years, and the stock price followed accordingly. As another more relevant example, think about the tobacco industry over the past 25 years. Altria, which manufactures cigarettes, has done incredibly well despite its negative reputation and harmful effects on society. Overall, money doesn't care if the business is disagreeable. If the earnings increase, the stock price will follow. Moving on to attribute number 4, it's a spin-off. As I discussed in my last video, a spin-off is essentially the opposite of a merger, being a division of parts of companies into separate freestanding entities with their own stocks. Peter Lynch says spin-offs such as Safety Clean or Toys R Us often result in astoundingly lucrative investments, and they are a fertile area for amateur investors. He says spin-offs occur because management thinks their business is undervalued by the market and believes, with good reason, splitting up the business into a simpler structure will force investors to revalue the spin-off and parent companies more in line with the comparable companies. Large companies don't want to spin off their divisions and then see them get into financial trouble, because it would then reflect back on the parent companies. Therefore, the spin-offs normally have strong balance sheets, and they're very well prepared to succeed on their own as independent companies. So it's always a good idea to look into a spin-off company to understand their fundamentals, their growth prospects, and if insiders are buying into that spin-off company. Attribute number 5, institutions don't own it and analysts don't follow it. Peter Lynch says a stock is a potential winner if it has little to no institutional ownership, and it's a double winner if no analysts cover it. You can frequently find this with banks and insurance companies since there are thousands listed across all of the exchanges. He's also very enthusiastic about once popular stocks that analysts decided to abandon since they gather much less attention than the stocks that analysts normally cover. For example, one stock that I've talked about a ton on my channel and a huge investment of mine is Trulieve Cannabis. This company has no institutional ownership since cannabis is still federally illegal in the US and the funds simply aren't allowed to invest in these companies. But Trulieve's fundamentals and future growth prospects are unbelievably good. So once cannabis is federally decriminalized, institutions are going to plow money into Trulieve along with many of the other US cannabis stocks, and this will surely increase their stock prices. Getting into attribute number 6, rumors abound. It's involved with toxic waste and/or the mafia. Lynch believes it's hard to find a more perfect industry than that of waste management. Not only is the business involved in something disagreeable, being attribute number 3, but the mafia has long been associated with the waste management industry. These two factors were great advantages to the early buyers of shares in waste management, which as usual were undervalued compared to the actual opportunity. Now the same can be said about the hotel and casino businesses. Everyone dreaded these stocks as they were associated with the mafia in early days. But nowadays, everyone would love to own stocks like Wynn Resorts, which are heavily involved in the casino and hotel businesses. Once the company earnings explode, the mafia news turns into noise and just fades into the background. Alright, now for attribute number 7, there's something depressing about it. Obviously, finding an industry involved with death in any way would fit this category pretty well. Peter Lynch says if there's anything Wall Street would rather ignore other than toxic waste, it's mortality. This is why one of his favorite all-time picks is Service Corporation International, which does burials and also has a boring name. This company pioneered the pre-need policy, whereby it allows someone to prepay your funeral service and your casket right away while you can still afford it, so that your family doesn't have to cover the cost. They also allowed you to lock in the current prices even if it costs 3 times as much down the road. Again, this is a company that had a solid earnings growth track record while trading at a much lower valuation than a high-growth tech company at the time. As we can see today, SCI is still a public company and is now trading at all-time highs, being up over 1,800% since 1988 and up 160% over the past 5 years, being a compounded annual growth rate of 21%. Overall, picking a stock in a depressing industry can help keep the smart money away for a while, giving you an opportunity to purchase shares at a discount before they are recognized as cheap. Attribute number 8, it's in a no-growth industry. Most people prefer to invest in a high-growth industry since ideally the company could grow with that industry over time. However, the problem with high-growth industries is that they attract a lot of competition. For example, Peter Lynch notes the carpets industry in the 1950s, electronics in the 1960s, and computers in the 1980s, and some more recent examples would be the electric vehicle industry or the software as a service industry. To avoid this hyper-competition, Peter Lynch prefers investing in industries with very low growth like plastic knives and forks or the funeral services industry, where there would be very little competition. The graduating class of Harvard or Wharton isn't going to want to challenge the existing companies within a low-growth industry or a boring industry like the funeral services. They're all going to be up in the tech alley. Attribute number 9, it's got a niche. Peter Lynch also believes it's best to invest in a company with its own niche or exclusive franchise, which can be extremely valuable to the company and its shareholders. Lynch gives the example of a local movie theater and then compares it to a rock pit business. The movie theater will compete with other movie theaters in the area, while the rock pit is insulated from competition because of the unpopularity of rock pits, as well as the high cost of transporting rocks from another rock pit in a different city or area. Therefore, you can raise prices to just below the point the owner of the next rock pit will begin to think about competing with you. Another great example would be the pharmaceutical industry. Once a drug is approved, patents protect that drug's competitive position. Competitors will have to spend billions of dollars to invent a different drug, prove it is different, and then spend years in clinical trials before the government will let them sell it. For example, AbbVie, the $200 billion pharmaceutical company, is very well known for its patented drug Humira, which has gained huge market share, preventing competitors from selling within the industry for many, many years. But now let's move on to attribute number 10. People have to keep buying it. One of the attributes of the perfect stock is that the underlying company's products are always in demand, thus leading to recurring revenue. Peter Lynch says he would rather invest in a company that makes soft drinks, razor blades, or cigarettes rather than a company that makes toys. A perfect example would be the razor company Gillette, which was acquired by Procter & Gamble in 2005 for $57 billion. This is why companies like Procter & Gamble or Johnson & Johnson are known as some of the safest companies in the world because their products are always in demand. Attribute number 11, it's a user of technology. Instead of buying the company that manufactures scanners, buy the grocery store chain that can utilize the scanners to save costs. With new technologies comes an endless price war, so the developing companies might end up reducing their profitability over time. However, this price war will actually benefit the businesses that use the technology. If a scanner helps a supermarket company cut costs by just 3%, that alone could double the company's earnings. As another example, in today's day and age, we could think about a company that uses software such as AWS, like Amazon Web Services, or Microsoft Azure cloud computing, and these could increase the profitability and reduce the overall cost of businesses substantially. Or even the software provided by Palantir, which is supposed to reduce costs and improve efficiencies like crazy in businesses. Alright, now getting into attribute number 12, insiders are buying. Peter Lynch argues that there's no better tip-off to the probable success of a stock than the people within that company putting their own money into it. In general, corporate insiders are net sellers, in which they normally sell 2.3 shares for every single share that they purchase. Now, there are a multitude of reasons why an insider might be selling shares. For instance, they might be buying a new home, going on a vacation, paying for a child's tuition, etc. However, there's only one reason why insiders will be buying stock in their company, because they feel that it's undervalued and the stock price will go up over time. A high insider ownership is also a vote of confidence to the shareholders, since the insiders are aligned with your goals as the shareholder to try and make money. Overall, insider buying and high insider ownership are two very good signs for a stock. And last but not least, the 13th attribute is the company is buying back shares. Peter Lynch says buying back shares is the simplest and most effective way a company can reward its shareholders. Just like you or I might choose to invest in a company with good prospects, why shouldn't a company reinvest back into itself? When stock is repurchased by a company, those shares are taken out of circulation, thus shrinking the number of outstanding shares. This has a positive effect on earnings per share, or EPS, because even if the company is at the same level of profitability from the year prior, if they reduce their share count, the EPS will rise. And as I'm sure we all know, stock prices follow EPS over time. So if the company is remaining profitable at the same level of profitability and then those shares are reducing over time, the stock price will go up with that EPS. For example, Apple has been aggressively repurchasing their shares since 2013 and has since decreased their share count by over 36%. Consequently, their EPS has also been rising steadily over this time as well. Anyways, to summarize Peter Lynch's 13 attributes for the perfect stock, you need to find a company with a dull or ridiculous name that does something dull or disagreeable, the company is a spin-off of a larger parent company, institutions don't own the stock and analysts don't follow it, rumors are common, or the company is involved with a mafia or toxic waste. There's something depressing about the company. It's in a no or slow growth industry with its own niche. People have to keep buying the company's products. The company is a user of technology, but not necessarily a producer. The company's insiders are buying or have a large ownership. And finally, management is repurchasing shares in the company. So anyways, that is all for this video. I really hope you did enjoy these 13 attributes of the perfect stock, and Peter Lynch is an awesome investor, so I think he has some really good points in this list. Let me know down below if you can think of some stocks that might fit a few of these characteristics, or a stock that can fit all of them. I would love to hear. But as always, if you did enjoy, make sure to drop a like on this video, as it does really help support my channel. And if you haven't already, make sure to subscribe down below so you don't miss any future investing content. And with that said, I will see you guys in the next one.